Welcome back in, ladies and gentlemen. We are going to talk about a new position that I just added into my portfolio, and we're going to talk about if Paramount were to get bought out, what should they be bought for? So we'll get into that. We'll talk a little bit about Warner Brothers Discovery and the streaming landscape overall. And I did want to touch on Paramount because I did an analysis on them almost 2 years ago, had about a $15 to $16 price target, actually $16.50 I believe it was. So you have to keep updating the price on every earnings call. Make sure that you're staying on top of the latest news and that your valuations are on track to what the company is actually producing. And if you're new to the channel, welcome in. Let's talk about what I added in my portfolio. First off, I recommend nobody doing what I'm doing here. I'm taking on a lot of risk because I think US markets overall are pretty expensive. So where am I looking? I'm looking at very distressed assets within the US and emerging market opportunities. Reasonably valued is actually US healthcare. A lot of the healthcare companies, your Bristol Myers Squibb, your Pfizer's, which we added some of those, they're building out their pipeline. And I see a lot of comments talking about that these companies have kind of just done nothing for the last 10 years. And that's true. But if you look at where I'm buying the companies, that tends to be a pretty reasonable valuation throughout history. They've hit this level before, they build out their pipeline, and then the stock shows some appreciation longer term. So my goal here is not to get a 10x stock with these companies. My goal is most likely they're in a value state, and there's probably not as much downside risk to a Bristol Myers Squibb and or Pfizer at these levels. Now, with that being said, of course they can go lower. My goal for these is to really make them a part of the portfolio that keeps the beta low and adds some yield in my portfolio. That's strictly the goal of that. Hopefully their price volatility is not crazy, and if it is, hopefully it's to the upside. But specifically, I want to talk about what I just added to my portfolio, and that's going to be InMode. This is a company that's trading at 9-10 times earnings, small market cap sitting at $1.7 billion. And definitely mixed feelings with this one, as there's been a lot of downgrades in recent time, which has caused the price to go from over $40 a share down to $20 a share and actually hit as low as $18.57. I did pick up some around $20. And with analyst expectations, we can see it's pretty much all over the place, as low as $22, as high as $61. When you look at top line revenue growth, it's been very strong, going from 87%, 56, 31, 73, and 27% recently. Had a pullback here. Their growth is slowing down, and big part of what's taking place in their stock price is twofold. Number one, growth drastically slowed down. Number two, they're headquartered in Israel, designing, developing, and manufacturing innovative aesthetic medical products with some patent procedures here. So not only do they have proprietary products, but they also have that top line revenue growth, and they're growing pretty rapidly here. And one of the reasons why the stock is down is that growth is slowed, and a big part of it is also where they're headquartered. So a couple headwinds here that I think is lending an opportunity to pick up a pretty interesting stock that has not only patents, but a pretty solid business model in a growth phase right now. And, this definitely would be a higher risk, higher reward, once again, type of stock. And if you guys have been following, I'm looking for distressed assets to just start building out some small positions, as I stated before. I just think when we look at the overall market, very overpriced, but I think there's some interesting pockets where you can possibly take on some risk. And this is definitely one when we consider small cap, emerging markets, and kind of in that consumer discretion, beauty side of things where there's a tremendous amount of money to be made. The company has done a great job of deploying capital, phenomenal margins within their business, profit margin sitting at 36%, free cash flow sitting around $170 million. For a $1.7 billion company, in a growth phase, it's very hard to find a company that's actually trading below 10 times free cash flow, and a very clean balance sheet and deploying capital well. So when I look at the market cap of this company and I think about the total addressable market ahead of this company, along with the patents that they have, makes this one pretty interesting. And then when we look at the balance sheet, they have a net cash position of $672 million. So InMode is a position that I added to. Once again, this is kind of high risk, high reward. And actually for emerging markets and smaller cap companies, this is one of my larger positions, making up 1% of my portfolio right now. So if we look at where we are, I got a cost basis on Pfizer at $28.79, making up $430 of my portfolio. KWeb making up $381. Now KWeb, I would probably add another $150 to $200 more, as I stated, if it got back into the $17 range. And then InMode making up a pretty substantial amount when we're comparing it to what else I own, just above Bristol Myers Squibb, which on a big pullback, I would like to add a little bit more of Bristol Myers Squibb. This is kind of where I'm seeing some value right now within the stock market. Of course, these are higher risk type companies where I definitely think there's an opportunity for some of these companies to go under, but I also think there's an opportunity for them to 3x. So they're making up a very small portion of my portfolio. Once we get opportunities that I feel like Megatech maybe sells off, or we get a market pullback and we start seeing pockets of opportunity, then I'm going to start building into higher quality type companies and build out that barbell approach where we have growth in emerging markets on one side, but then we have that blue chip quality company on the other side. Now, I did a video a while back on Paramount Pictures, giving it right around a $16.50 price target when advertisers were actually paying money to go on these platforms. And we've seen advertise spend slow down, which has obviously impacted some of the streaming. And it's been a very unclear picture on streaming. So these are very hard assets to come up with valuations on. I also stated that this is a very high risk investment. Even Warner Brothers is pretty high risk when we look at the debt load that they had. But what made Paramount more interesting to me, I think their valuation's compelling when we look at the type of revenue they can do, and then it comes down to, is there margin growth down the road and some of the assets they own. So we, on a EV to EBITDA price target, I had $15.37. And this, when the company was actually showing some free cash flow, we got around a $17 price target, which gave us right around a $16.50 price target. WBD, I basically got an $8 to $9 price target on WBD, Warner Brothers Discovery. Now, I actually think the price target is going to go up here because they are controlling they did pay down debt substantially. So we're going to revalue Warner Brothers Discovery here because they have done a good job paying down debt, and revenue growth was there as well. So let's update that really quick, which actually makes it pretty darn close to a buy here, putting it at a $9 to $10 range. For me personally, that's actually pretty interesting. And we will look at analyst expectation for Warner Brothers Discovery. We have $10.17 and 36. Paramount is $9.16 and 32. And so when we look at Paramount Pictures doing $30 billion of top line revenue, what we projected out nearly 2 years ago is not what they've been doing. So we have to always update your analysis here and make sure that companies are executing to the standard that you set out for them. Total debt is sitting at $17 billion. So just by kind of updating Paramount, we get closer to basically $11 to $13 price target, which kind of puts them in line right now for the price that they're kind of sitting at here. I definitely think the assets itself are worth more than that. But when we look at the company as a whole and base it off the fundamentals, I definitely think it's worth probably fair market right now, maybe closer to $11 a share. But if you're selling these assets individually, then I actually think the company's worth more. So an acquisition price is going to possibly be closer probably to $15 and $20, I would imagine. So if I wasn't looking for a rate of return on this, and I just put 0 in there, $25 to $28, I wouldn't be shocked would be the value that they would be buying this company for. And so if you look at what that would be, so if I were to look at this company and guess what somebody would offer the company based on my analysis, I would say that a $15 to $16 billion buy would make sense. And that would be sitting right around a $24 to $25 stock price. But that's just me guessing, guys. So obviously don't take that for what it's worth. But there's been a lot of news coming out about this being an acquisition. And I think when we look at streaming, this is one of the better acquisitions a successful streamer should make, because you have the CBS live sports side of things, but you also have, basically 100 years worth of movies and content. So, when we kind of just review the assets that they own here, MTV, Country Music, Comedy Central, CBS, Nickelodeon, CBS by itself is probably worth a few $1 billion with the NFL package that with the NFL agreement that they still have intact. And then obviously you have the Paramount Pictures itself. So, I definitely think there's a tremendous amount of assets here that you're getting. And so when we think about buying this company for that kind of price, how much would it cost anybody to get into the streaming world and have all these brands? It'd be multiple of tens of billions of dollars. I think a $15 or $16 billion acquisition makes a tremendous amount of sense here. If you are successful streaming, I personally thought it makes a better fit for Disney and or Netflix But I also think Warner Brothers Discovery is kind of interesting at these levels as well. I do think they are getting close to success here. So, I think if this dipped back into the $8, $9 range, I would be interested in taking on a little bit of risk with this one. But we're going to see consolidation, guys. We've been talking about M&A taking place, and this is definitely an area of M&A that's going to be happening, I think, more frequently. And we're going to really see the competition start picking up, I think, for the streaming, because we got Disney now getting pretty close to profitability here on their streaming side. You have Warner Brothers Discovery doing some interesting things, and then you kind of have this distressed asset in Paramount Global that's kind of trading for a substantial discount when you look at underneath the hood what they really have for assets. And if you were to buy those assets individually, I definitely think it's worth more than what they're trading for as a whole. As always, guys, really appreciate your time. Thank you so much for spending it with me.